Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. I'm doing it a little bit later in the week because we have been slammed with work. It's a good thing, not complaining. And also, I wanted to make sure we got the jobs report information in, which was huge because that is going to move the Fed on rates. So here we go. Before we get into that, I wanted to talk about this real quick because this is floating around the internet. Home purchases, and this is from Redfin. Home purchases are getting canceled at a record rate. Oh no, sky is falling, right? And I mentioned this a couple weeks ago, but I wanted to mention it again in that basically we're at similar levels before pre-pandemic. Here in the Phoenix area, we're at 4%. They're revising this using short window numbers and stuff. Long story short, it's not quite as bad as Redfin is saying, and Redfin does put out a lot of clickbait. So that said, nothing crazy happening there. Homes are definitely sitting longer, um, and but there's a little less inventory right now, and rates did just drop this week, which we're going to talk about right now. So we have the payroll rose 22,000 in August, so that was 22,000 jobs, less than expected, and further sign of hiring slowdown. We may see some revisions over the next week or two. And the Fed meets in a couple weeks. So we're definitely going to keep an eye on that. I think it's the 18th and 19th. Sorry to get that pulled up. But because we've had a couple of really horrible job reports, we're at 4.3% unemployment right now, which was the original benchmark. Then it went to 4.5. Before that, it was all about inflation until they spiked the eggnog, as Logan Monashami likes to say, in around the end of the year of 2022. And they said, no, it's labor over inflation. So the Fed keeps moving the goalposts, and here's where we are. And people are scratching their heads when they did lower rates before the last election, which makes people think it's political. But that aside, we have to say that they have nowhere else to really hide now when it comes to this. Too late. Powell is definitely too late because we knew that the jobs market was weakening, and we kept saying that. And the reason why we know this is because number one, manufacturing has been dropping off for quite some time. Overall trend in dropping off, not really a steady a good steady path there, and we've seen a big decline over the last few months. And then the other one, and these are the two biggest indicators, because before every recession, we have what we track is manufacturing and residential construction. So when we look at this, we have to look at, okay, this is dropping off, and we're like, okay, with the two of those, now the Fed is way behind. So what that means is they're being forced into lowering rates, and the bond market already priced this in. Okay. And it dropped below the benchmark of that 4.18 that we talk about here once in a while, because the 10-year treasury tracks with the 30-year mortgage rate and the average rate across the country. And historically, you'll find that that is about a 1.75 to 2 point spread. Okay. So this dropped mortgage rates to the lowest rate in about a year. So right now, we ended the week at 6.29%, 30-year fixed across the country. Again, right now, a lot of lenders are just without even any buy downs or anything or any special programs. If you're working with a mortgage broker, you're probably going to be in the fives. Okay. Now we can get that rate down lower, have the seller or builder pay for that. So please reach out if you have any questions about that. Also, you can get assumable loans, which you talk about right now, where you assume somebody else's lower interest rate that they already have. So this is going to be key because as we talk about, mortgage application data has been up now 31 weeks going into this week. And we see that forward looking, that tells us 30 to 90 days. Now, some of those are sellers and homes are sitting longer, but we know that that's good news for the housing market. It's also good news for the builders because whether it's a builder or any company out there, they need capital, right? They want to refinance that capital on their commercial loans and stuff for land or whatever. And so a lot of that comes into play when we're talking about what the Fed does. A lot of people say the tariffs, the tariffs, the tariffs, but housing hits so many different sectors of the economy, right? You have people who are building a home. They're buying furniture for the home, food for the home. They're having family formation. They're having kids. As Logan Monashami says it, the Fed hates it when people get married, have kids, and have sex and have kids. And they don't like that because they're afraid that's inflationary kind of stuff that's happening when we talk about growth and spending. But I think we're going to see some restructuring at the Fed. I would say, forward looking, we're probably going to see that target of 2% inflation probably change to 3% eventually. Some other restructuring going on there. You know, Lisa Cook has her alleged crimes right now they're looking at. Powell's kind of so far backing her on that. Even though she's been fired, she's saying she's not going to leave. So we'll see how that all plays out. But, if they don't lower the rates at this point, they have nowhere else to hide. If they don't lower the rates on the Fed rate, which indirectly can affect, it's not a one for one, but it can indirectly affect the bond market and mortgage rates. It's more of policy direction. So if they come out and signal that, okay, yeah, jobs market is super weak now, we need to shift policy, and we're not, I know President Trump talks about 3% lower. Scott Bessent came out about a week ago, said, it should be 150 to 175 basis point lower. In other words, a neutral policy. They should have never went over 4%. Right now, we're sitting at 4.2 to 4.5. We should be closer to a 3% neutral rate. And that's reality, really. Because, if you want to have to wait and see what's going to happen with the tariffs, which hasn't happened yet, and we're also probably going to see some more of those government jobs that were lost. And that's going to be a huge impact, but by next month, that should hit the labor sector for all the people who were laid off. I think it was a total of 90,000 people in the federal government, I believe. Don't quote me on that, but I think that's what I heard this week. But anyways, as far as those cancellations I was talking about earlier in the Phoenix area, it's 4%. Builders, as far as the tariffs go, you know, their lumber, they only import about 10% of the lumber. A lot of that comes from Canada. And total imports are 7%. So that really isn't going to have a huge effect. What does have a big effect is regulation. Regulation has a huge effect on builders by 25%. And they're talking about easing a lot of those regulations. Now, if they do that, not crazy loans and stuff like we had under the Bush administration, where in 2006, where that was a disaster, but regulations on some of the builders and permitting and stuff, we're going to see that loosen things up a little bit, where maybe some of our pricing will level off or even possibly go down, along with opening up some lands and stuff. So we'll see how that goes. But in order to get sub 6% on the average, we need to be back to, let me go back to sharing my screen here with you. We need to be lower than 380 on that 10 year. And right now we're at 4. And that puts us right now with the spreads between the 10 year and the mortgage rates at 6.2. Spreads have been getting better over the last year. That's good news. Remember where we've come from, guys. A lot of it's just been the spreads getting better, the economy getting a little bit better overall, but in the bond market, playing along. But we've got, we're still about 29 points higher or more where we should be on the spreads, but we're getting closer. So just the spreads alone, it brought us from the 7s, even all the way up to 8, down to where we are now in the bond market, which affects the 30-year mortgage rate. Okay, and that, again, this is just the average. Somebody asked, what if we wanted to get sub around 5%? You'd have to be below 3 on that 10-year treasury. So we're not there yet. We'll see how things go and how that shakes out. So anyways, guys, that's where we are there now for the greater Phoenix area. Right now, we have 66% success rate on listings. Okay. And the builders right now are running just over 9 months supply, but that's the dirt and everything and associated with building a home. But the completed properties, those are about a 2.2 month supply. So we need to get those numbers a little bit lower, but because a lot of these homes are already built and spec'd out. Okay. So right now, this number, just last time I did the report, I think it was at 78 on the market index. If we're between 90 and 110, we're in a balanced range, 100 being totally balanced. Below 90, we're in a buyer's market. Above 110, we head into a seller's market. If these two numbers on demand and supply are the same, this number is at totally at 100. So right now we're at 80. We're in an overall buyer's market. For our sellers market areas, we are at let's see, Paradise Valley always comes in the top. They're still at 193. They went up another 7%. The overall index has gone up 9.4% in the last week, 9.3 the week earlier on the Crawford Market Index, meaning towards back towards balance, which eventually will head it, into back to a seller's market eventually. But this is where we are now. So we're seeing this inch up pretty quickly, guys, pretty quickly. There's a little less inventory. Rates have been dropping. Rates are going to continue to drop by all measures that we can see. But the Fed, even though the bond market is always ahead of the Fed and they price this stuff in, the Fed messaging, even before their meetings, their Fed messaging on their direction that they're heading and their policy, because they say slightly restrictive. I think they're very restrictive. But we had another Fed governor this week basically come out and say, yeah, we definitely should be lowering rates with these jobs reports. So I think we're going to see a big shakeup at the Fed. Next meeting, we should get at least 25 basis points. It should be more, but they're going to do at least 25 basis points. Again, will that be enough to move the markets? It depends on the messaging. And we're going to see how the rest of the year shakes out. Sometimes when they lower the Fed rate, it doesn't always have a drop, a big drop into the bond market. Right now, again, they're way behind the bond market. So really, they probably need 50 to 75 basis point cut to really get the bond market to move a little bit more. So we'll see how that goes. The heat map here on the greater Phoenix area, right now, Glendale in 85310 is definitely in a hot market. Okay, with the contract rate, this is what's active and what's under contract. Chandler in 85226, Gilbert 85234, and Mesa at 85203. Everything else is kind of balanced to cold right now. So we'll keep an eye on that. We've had a bunch of open houses coming up. With our next open house is going to be tomorrow over in Peoria at 7242 West Crabapple Drive in Peoria. This home is a 5-bedroom, 3-bath, 3463 square feet. It's got a pool, it's got a spa, it's got a balcony. It's got a ton of updates in the property. It's a beautiful, beautiful home, well appointed. The lot is over 10,000 square foot, offered for 709, and we're going to be there tomorrow, Sunday, from 10 to 2. So, guys, that's all I've got for you today. I'm kind of keeping it short and sweet. If you have any questions at all, please reach out, and we'll see you next time. Thanks.